the past few days, everyone has been staring at their screens trying to make sense of the madness. Flash crashes, empty dealer inventories, price gaps between New York and Shanghai that make no logical sense, traders yelling, algorithms tripping over each other, and financial TV acting shocked, as if markets have never misbehaved before. All of this looks dramatic, but it is just noise. These are not the real story, they are symptoms, the violent tremors of a market structure that is already breaking apart. Because while traders were busy fighting over pennies, the most important event in modern silver market history happened quietly, without a single headline ticker flashing red. No panic, no drama, just a pen moving across a page inside the Oval Office. On Wednesday, January 14th, 2026, President Trump signed a proclamation that may go down as the moment the silver market officially entered a new era. On the surface, it looks like dull bureaucratic paperwork, another government document destined to be forgotten in an online archive. But buried inside the legal language is a policy reversal so extreme that it effectively ends a 50-year war against precious metals. This proclamation was issued under Section 232 of the Trade Expansion Act, the same authority used for steel, aluminum, and other national security industries. That alone should get your attention. This is not a trade spat. This is a national security declaration. And the language is unusually blunt. The proclamation states that America's over-reliance on foreign imports of processed critical minerals is a direct threat to national security, not an inconvenience, not a market distortion, a threat. In government terms, that word is nuclear. Threat is what unlocks emergency powers. It is the language of wartime policy. But the real shock is not in the diagnosis. It is in the proposed cure. In paragraph 13, the president writes that, depending on negotiations, he may consider alternative remedies in the future, including minimum import prices for specific types of critical minerals. And again, in the operative section, he instructs the Secretary of Commerce and the trade representative to consider price floors for critical minerals. Price floors. That is not a typo. For half a century, U.S. monetary policy treated precious metals as the enemy. Cheap gold and silver were considered proof of a strong dollar. Rising metal prices were seen as a vote of no confidence in the currency. So the goal was simple: keep metals quiet. Futures markets were used to cap rallies. Leasing programs added artificial supply. Volatility was tolerated, even encouraged, as long as prices stayed contained. Now the policy has flipped completely. The U.S. government is no longer worried that metal prices are too high. It is openly stating they are too low. That is not a technical adjustment. That is a philosophical reversal. And the reason is painfully simple. Reality finally caught up with financial theory. You cannot build a missile with a futures contract. You cannot build a power grid with a derivative. You cannot electrify an economy with spreadsheets. You need physical metal, actual atoms, dug out of the ground, refined, stockpiled. And you cannot have a domestic mining industry if prices are allowed to collapse every time a trading desk sneezes in Chicago. For decades, paper markets were allowed to dominate physical markets. Price discovery migrated from mines and refineries to trading algorithms. The result was a market that produced beautiful charts and terrible supply chains. Section 232 signals that Washington has finally noticed the difference. This is the shift from financialization to industrialization. In a financialized economy, low commodity prices are good. They keep inflation down and asset bubbles inflated. In an industrial economy, low commodity prices are dangerous. They destroy production capacity. The U.S. now understands it cannot fight a war, build a grid, or run an advanced economy while depending on geopolitical rivals for the raw materials. Supply chains are not just economic structures anymore. They are military infrastructure. But rebuilding a mining sector is not like restarting a factory line. Mining is slow, expensive, and brutally capital intensive. It takes a decade to permit a major project. It takes billions to construct. And it carries enormous political, regulatory, and geological risk. No rational board of directors will approve a billion-dollar silver mine if the price can collapse 40% in 6 months because a hedge fund flips its positioning. So the government must do something radical. It must remove the downside risk. That is exactly what a price floor does. A price floor is a government-sponsored put option. It tells producers, build the mine. If the market price collapses, we will make you whole. It converts mining from a speculative gamble into strategic infrastructure. This single policy tool changes the risk profile of silver entirely. For the past decade, the dominant fear was always the smash. Every rally carried the memory of sudden collapse. Retail investors lived in fear of regulatory surprises and paper sell-offs. The risk was structurally skewed downward. Now the government itself is saying that falling prices are a national security problem. That means the downside is no longer just financial, it is political. This does not eliminate volatility, but it places a safety net under the market. The violent drop to $90 that panicked investors is not the beginning of a bear market. It is the exact instability the proclamation is designed to prevent. The government is no longer neutral. It is now aligned with price stability at higher levels. We are moving from a market dominated by bankers who profit from turbulence to a market influenced by strategists who require reliability. This is the dividing line in history. Before the proclamation, silver was a speculative toy for Wall Street. After the proclamation, silver is a strategic asset for the Pentagon. Same metal, completely different mission. And once you understand this, daily price swings become background noise. The long-term direction is now being shaped by national security policy, not quarterly trading strategies. To understand why Washington has made this pivot, you must unlearn 40 years of economic conditioning. Modern policy was built on a simple belief. A strong dollar requires cheap commodities. Gold and silver were treated as dangerous thermometers of monetary excess. If metals stayed cheap, inflation appeared under control. For a while, this seemed to work, but it carried a hidden cost, paid not in dollars, but in sovereignty. By suppressing silver to $15, then $20, the West systematically destroyed its own mining industry. Mining is one of the riskiest businesses on Earth. It requires massive capital, long timelines, and constant regulatory exposure. If prices are unstable, capital flees. And that is exactly what happened. Western investors abandoned mining, money flowed into tech stocks and financial engineering. Exploration budgets were slashed, skilled labor retired, equipment rusted, entire districts hollowed out, the mining ecosystem atrophied. While this was happening in the West, China was doing the opposite. Beijing never viewed mining purely as a profit center. It treated it as a strategic necessity. Chinese firms were subsidized, losses were tolerated. Assets were acquired globally while prices were depressed. The West optimized for quarterly earnings. China optimized for control of supply chains. This is what might be called the Great Hidden Subsidy. By suppressing metal prices, Western policy effectively subsidized Chinese industrial expansion. Cheap silver was not a gift to consumers. It was a discount to competitors. Only now is this becoming obvious. You cannot maintain industrial independence by outsourcing the foundation of your industrial system. And so the policy has flipped. High prices are no longer a problem to be solved. They are a tool to be used. Expensive silver is not inflationary excess in this framework. It is strategic investment. It is the price of rebuilding industrial capacity that was dismantled over decades, and repairing that damage will not be quick. Mines take years to plan and build. Skilled labor must be retrained. Supply chains must be reconstructed. Exploration must restart. Capital must return. That cannot happen at $20 silver. It likely cannot happen at $40 silver. It probably requires sustained triple-digit prices to justify the scale of investment needed to rebuild a Western mining complex. This is not a market cycle. It is a structural reset. The government has not merely nudged the system, it has reversed its polarity. The suppression machine has been switched off. The support machine has been switched on. This does not mean prices go up in a straight line. Markets never move politely. But the direction of policy is now aligned with higher, more stable commodity prices. That is the real story beneath the chaos. The flashing screens, the panicked headlines, the wild intraday moves, they are distractions. The future of silver is no longer being shaped primarily by traders. It is being shaped by national strategy. And once markets fully internalize that shift, the old price regime will look as outdated as a rotary phone on a trading desk. For years, we've been told that cheap silver was good for everyone. Cheaper inputs, cheaper products, happier consumers. Sounds wonderful in a textbook. In the real world, it worked a little differently. Every time bullion banks in New York slammed the silver price, they weren't just punishing speculators. They were handing a discount coupon to Chinese industry. When silver traded at $20 an ounce, it wasn't a bargain for America. It was a gift to the factories of Shenzhen. It lowered their production costs. It made their solar panels cheaper. It let them undercut Western manufacturers and quietly capture global market share. The cheaper silver became, the more dominant China's industrial base grew. So what looked like price stability in New York was, in reality, a massive wealth transfer from Western investors and producers to Chinese industry. We suppressed metal prices to protect the dollar, and in the process, we hollowed out the physical economy. We saved the financial system and lost the industrial one. The Section 232 proclamation is the government finally admitting this strategy failed catastrophically. Cheap silver is no longer viewed as an economic benefit. It is now classified as a national security risk. That is a stunning reversal. You cannot have energy independence if you rely on your strategic rival for the metal that carries electricity. You cannot maintain military superiority if your adversary controls the supply of the material inside your guidance systems. At some point, spreadsheets collide with reality. To break this dependence, the United States has to rebuild domestic mining capacity. That means reindustrialization, not slogans, not press releases, actual mines and actual ground, operated by actual workers. And here's the uncomfortable part. You cannot do that at $20 silver. You probably cannot do it at $50 either. Building a modern mine in the United States is brutally expensive. Labor costs are high, environmental regulations are strict, energy is not cheap, permitting a loan can take a decade. Capital is locked up for years before a single ounce is produced. No rational investor will take that risk unless the potential reward is enormous and, most importantly, stable. This is the logic behind the price floor. When the president talks about minimum import prices, he is not tinkering at the edges of trade policy. He is creating a state-sponsored safety net, a government-backed put option, a promise that if companies build mines, Washington will not allow the price to collapse below the cost of production. In plain English, it means this: if you build it, we won't let the banks destroy you. That single change transforms the entire investment case for silver. For the last decade, owning silver was an act of defiance. You were betting against the system, against the banks, against the Federal Reserve, against the Treasury. It was a lonely trade and usually a painful one. Now the trade has flipped. Owning silver is no longer protest. It is alignment with state policy. The government does not just tolerate higher prices, it requires them. So when silver drops violently, as it did today to $90, the old framework would say the rally is failing. The new framework says something very different. It says this volatility is strategically dangerous. A crash makes American mines uncompetitive relative to Chinese mines. It widens the gap Washington is trying to close. That means the government now has a direct interest in preventing collapses. We are no longer in a purely free market. We are moving into a managed market. And in a managed market, prices are tools, not accidents. They are set to achieve policy goals. The goal is supply security, and the only way to secure supply is with high stable prices that reward production. This is why the current distortion between markets is so important. If silver trades at $90 in New York and the equivalent of $12 in Shanghai, that spread becomes a vacuum cleaner, sucking metal out of the United States. Arbitrage bots do not care about patriotism. They care about profit. They will drain physical supply wherever prices are artificially lower. We end up selling our own strategic material at a discount while our competitor accumulates it. That is not trade, that is self-inflicted disarmament. A price floor is the wall that stops the drain. If the US sets a floor at $100, the arbitrage collapses. The metal stays domestic. Mines get built at home. Capital flows into American production instead of foreign supply chains. This is the real pivot. Price is not just a number on a screen. It is a signal. And for 50 years, we sent the wrong one. We told the world silver was abundant and unimportant. Now we are telling the world it is critical. Which brings us to the part most people miss. To investors, silver is money. To the Pentagon, silver is hardware. It is one of the most strategically important materials in the modern weapon system, even if it rarely makes headlines. Silver is the most electrically conductive element known. Nothing moves electrons more efficiently. In a world that is electrified, digitized, and automated, you can reduce silver usage at the margins, but you cannot engineer it away in high-performance systems. And the highest performance systems on Earth are military systems. This is where the national security designation becomes real. Take the Tomahawk cruise missile, the backbone of U.S. naval strike power. It relies on a silver-zinc battery to run its guidance systems in flight. That chemistry is used because it delivers exceptional power-to-weight performance and reliability. You cannot swap in a cheap consumer battery and hope for the best. This is not a flashlight. This is a missile. Look at the F-35 fighter jet. It is essentially a flying data center. Radar arrays, sensor fusion, encrypted communications, all of it depends on silver-coated contacts to ensure signals do not degrade at Mach 2. Consider satellites guiding drones and surveillance systems. They use silver shielding to protect against radiation and extreme temperature swings. Modern warfare is electronics heavy, and electronics run on silver. The U.S. military-industrial complex consumes millions of ounces of silver every year. Now here is the vulnerability that keeps defense planners awake at night. The United States no longer has a strategic silver stockpile. It sold it. Through the 1990s and early 2000s, Washington liquidated its reserves to mint coins and plug budget holes. The assumption was simple. The global market will always provide. That assumption no longer holds. COMEX inventories are thin, mints have shut production lines, and global supply chains run through China. This is the nightmare scenario. Imagine a major conflict erupts in the Pacific. The Navy needs to ramp up missile production. Contractors call their suppliers. Suppliers say, "We can't get the silver. China bought it." That is why the proclamation explicitly calls foreign dependence a direct threat. This is not about profit margins. It is about whether the system functions in a crisis. By framing critical minerals as a security issue, the president has effectively nationalized demand. Military necessity now overrides market convenience. This introduces the most powerful buyer imaginable, the price inelastic buyer. If silver rises to $500 an ounce, does the Air Force cancel jets? Of course not. They print the money, they pay the price. They care about capability, not cost efficiency. The Pentagon is the ultimate inelastic participant. And when an inelastic buyer enters a market with tight supply, it places a structural floor under prices. That is why this policy shift is so profound. The discount era is ending, not because banks became generous, but because the government became afraid. The logic of the system has changed. We are no longer optimizing for the cheapest price. We are optimizing for the safest supply. And in this new world, security commands a premium, always has. Up to now, we've talked about how a price floor protects the downside. It stops silver from collapsing below the cost of production. But that is only half the equation. The other half is far more powerful. Military and strategic demand does not just support prices. It forces them higher, to whatever level is required to secure supply. This is where silver stops behaving like a normal commodity and starts behaving like a strategic asset. Now add the second pillar of national security, energy. Energy independence is not an environmental slogan anymore. It is a geopolitical necessity. A country that cannot power itself cannot defend itself. And whether the push comes from one administration or another, the destination is the same. The U.S. grid is moving toward electrification and solar. A standard solar panel uses roughly 20 grams of silver. New high-efficiency TOPCon panels use even more. One administration called it climate policy. Another calls it energy dominance. Different branding, same periodic table. Both roads lead directly to silver. If the United States wants to reshore solar manufacturing, which is explicitly stated in the proclamation, it must have millions of ounces of silver available domestically. You cannot build made-in-America panels while begging China for silver paste. That is not independence. That is dependency with better marketing. This creates a silent bidding war for metal. Tesla needs silver for electric vehicles. Solar manufacturers need it for panels. Defense contractors need it for missiles. Civilian and military demand are converging on the same shrinking pool of supply. Until now, all of them were praying for lower prices. The Section 232 order ends that fantasy. It tells industry that the era of cheap imports is over. If you want secure supply, you must build it at home. And if you want to build it at home, you must pay a premium. This is why the recent plunge to $90 is not just a market event. It is a policy problem. If silver crashes, investment in domestic mining stalls. If investment stalls, dependence on China deepens. If dependence deepens, national security weakens. That is the chain reaction Washington is trying to prevent. So when the government steps in, it is not rescuing speculators. It is defending supply chains. For investors, this changes everything. You're no longer just long silver. You're aligned with U.S. defense and energy strategy. You have the most powerful institutional backer on Earth, whether Wall Street likes it or not. Silver is moving from the back of the cupboard to the front of the Situation Room. But this shift comes with a clock. Governments move slowly, but executive orders come with deadlines. The proclamation triggers a 180-day negotiation window. That takes us to July 13th, 2026. That date matters. By then, trade negotiations must conclude. If they fail, unilateral measures can follow. Tariffs, quotas, and potentially formal price floors. Between now and July, we are in a transition zone. The old world of suppression is dying. The new world of strategic support is not fully built yet. That in-between phase is messy, volatile, confusing, perfect conditions for bad headlines and shaken investors. It is also where opportunity lives. Markets do not wait for official announcements. They move in anticipation. Smart money does not show up after the policy change. It positions before it. If the market believes that in 6 months the U.S. government will guarantee a floor price, hypothetically $120 to make mining viable, the market will not wait until July to trade at $120. No rational seller would part with metal at $90 today, knowing the state may guarantee a higher price tomorrow. Supply withdraws, buyers front run, the price moves early, markets are forward-looking machines. That is why the current volatility may be the ultimate bear trap. The last great attempt to shake out weak hands before political reality takes over. The banks want your silver cheap before the government makes it expensive. So what is the rational strategy in this transition zone? It is not panic trading. It is strategic accumulation. We are in the gap between the collapse of the old system and the construction of the new one. Prices are still being set by a broken paper market, even though the metal has been reclassified as a strategic asset. You're buying a national security material at a speculative market price. It is like buying land where you already know a major government complex is about to be built. The announcement is public. It is just written in legal language that trading algorithms are not trained to read, but a warning is necessary. This transition will not be smooth. The institutions that profited from suppression for decades will not quietly accept a new order. They will lobby. They will attack the policy. You will see economists suddenly rediscover their love of free markets. conveniently ignoring that this market has been managed for years. Expect noise. Ignore the noise. Watch the safety net. When a U.S. president signs an order explicitly referencing price floors, he has placed a government guarantee under the market. It is not theoretical anymore. It is written policy. Think about what that means for risk. If you buy silver at $100 and the government later sets a floor at $90, your downside is defined. The state has signaled it cannot afford a collapse. If silver crashes, mines shut. If mines shut, missiles do not fly. That is not acceptable. In effect, a portion of your downside risk has just been transferred from you to the U.S. Treasury. If the price falls, the government must act. If the price rises, you keep the gains. That is an asymmetric trade. Capped risk, open-ended upside. So when you see silver trading around $90, do not read it as weakness. Read it as a policy mismatch that is about to be corrected. The lower the banks push the price, the worse the strategic distortion becomes. The spread with China widens. Metal drains faster. The national security problem intensifies. Paradoxically, the deeper the drop, the faster the intervention. We are watching a collision between two forces. On one side is the deflationary pressure of a debt-saturated banking system. On the other is the inflationary force of a reindustrializing state. History is very clear on how this ends. In times of war and strategic crisis, the state always wins, banks adapt, prices reset. This national security pivot completes the picture. First, the physical shortage. Second, the paper market stress. Third, the political guarantee. 3 legs, stable structure. This bull market is no longer just a speculative thesis. It is a policy objective. And that brings us to the final verdict. July 13th, 2026 is the deadline on paper. But the real deadline in the market is now. Do not wait for the official announcement of a floor price. By the time it is announced, the price will likely be trading above it. Markets move before policy becomes law. Use the volatility. Use the confusion. Secure your position while the paper price is still detached from strategic reality. The United States government has effectively drafted silver into national service. It is no longer just a commodity. It is part of sovereignty. And sovereignty, historically, is never cheap. Hold your metal. Watch the countdown. We are entering a world where silver is no longer priced like a rock pulled from the ground, but like a component of power.